It's a business with higher margins than most grocers and is growing like crazy. The bigger and bigger companies get, they tend to have to compress their margins. The best deals happen in great companies when they have short-term problems. 5 stocks that we think are very interesting. Now, we're not going to disclose where we're buying, what we're buying, etc., but we're going to go evaluate these stocks from a 500-foot view, a high-level view, talk about some positives, talk about some negatives going forward. First stock, Sprouts Farmers Market. A year ago, we went to Arizona for my dad's 70th birthday, and we kept shopping at Sprouts.
Nice.
They didn't have pop.
Oh, one of those places.
At that time, I don't know if it's still the same. They didn't have normal pop. They had the hippie stuff.
Yes.
But it's a business with higher margins than most grocers and is growing like crazy. They have a lot of potential.
They have great homemade cookies.
They have great homemade cookies. They had great chips, too. So let's take a look at them. $3.5 billion market cap. Obviously, a little bit more debt. The difference between enterprise value and market cap is debt. Profit margin, 3.8%. 5-year profit margin, 3.9%. As an example, let's pull up Kroger.
Were they about 2%, if I remember correctly?
It's about 1 or 2%. Let's see. So 1.3 is the 5-year average, 1.7 overall. So they're trying to be more niche. And I like the fact they're smaller because the bigger and bigger companies get, they tend to have to compress their margins, especially if they can't support the big growth. 14 PE, 14 5-year PE, not bad. I like this return on invested capital.
Yeah, that's very nice.
They're doing a good job of investing the money back in the business, and I think this is probably lower than it should be, based because they're growing and they keep reinvesting. They just got their CEO, who is the guy from the 99-cent store, so we like that a lot. Analyst estimates have them growing consistently, not a ton. Small company, $3.5 billion market cap, reasonable growth, nothing crazy. They're also talking about buying back shares when it makes sense. Revenue growth also growing from $6.8 billion according to analysts to $9.5 in the future. Mo, should we do a stock analyzer tool on this one?
You want to?
Well, we have 5 stocks to do. The question is, which one do we do stock analyzer tool on?
No, let's not do it on this one. If you go to my screen real quick, though, the buying back of shares, in 2021, they had 118 million shares outstanding. Now they have 103.
Okay.
103.8. So buying back shares at the right times.
Remember, lower PE with growth potential, high return on invested capital. It could be a cheaper business. Let's go to the next company. Ready? Rowe Price. Let's check out this Rowe Price stock, and here's why, guys. And by the way, if you want to run the stock analyzer on Sprouts, just sign up for the software. It's $7, 7 days, $1 per day. Don't be cheap.
Try it out.
What are you doing?
Yeah.
Literally, if I asked you to Venmo me $1 right now, you would do it every day for the rest of your life. You never blink an eye. Just do it. This is going to change your life. Give me a break. Everythingmoney.com. Sign up now. Rowe Price. Mo, look at this fall. 224 to a low of 93. It's currently at 106.
It's down by near COVID levels right now.
Yes, it is.
Wow.
Is it really neat? Oh my God, you're right. I didn't even think. Well, it got like 75
COVID got
or
lower,
something.
but I mean, it's around that. It's hovering there.
Look at this return on invested capital, Mo.
Yeah, it's huge.
So the question is, how can they reinvest their capital, get higher rates of return? Listen, they're a great 401k business, very well known. Those businesses are very sticky, which we like a lot. Here's the other thing I like. $24 billion market cap,
That's
$24 billion enterprise value. Okay? 5-year PE is 11. 1-year PE is 17. Guys, their revenue and profit will be subdued as the market goes down.
Yeah,
that is an absolute fact.
Yep, it's going to fluctuate.
So they just reported their quarterly. They did $1.54 billion, and that was down almost 20% from the year before.
Wow.
1.54 versus 1.86 same quarter a year ago. Why? What happened at that time? Revenue, market went down, therefore revenue goes down.
Yep.
So running it through stock analyzer tool. Let's look at analyst. Actually, first off, let's look at the 8 pillars. Okay, 8 pillars. Net income's down, as we expected, because the revenue's down.
Right.
But everything else is a check mark. And don't forget, if you have our software, you can customize your 8 pillars to have up to 12 different pillars, up to 4 quadrillion different variations. This is your tool. Buying back shares, which in the past at these higher prices probably didn't make much sense, Mo. I don't know.
Yeah. And honestly, though, they haven't really been buying back. I mean, this is quarterly. I'm sorry.
Yeah,
let me go to 4 quarters. Let's see what they're doing here.
Yeah, they're buying back a good amount.
Buying back shares. Yep.
They've been aggressive.
Yeah, they have. And especially going through 2020 when they were at astronomical levels.
Still buying back shares.
Yeah.
So again, we don't like that, but this is a company
dividend
that generates some really good dividend.
Yeah,
4% dividend.
4.6.
6.6% dividend. It eats up $1.1 billion of their $2 billion average free cash flow. But in the last year, they did $1.5 billion in free cash flow. So it's eating up a big chunk of their free cash flow, which tells me they don't see a use in their money. They don't have debt, basically.
Right.
And all they can do, basically, is make acquisitions, buy back shares, pay down debt. Well, can't pay down debt, pay dividends. So you look at it going, okay.
Yeah, makes sense.
Yeah. So let's run a stock analyzer tool on this one.
Okay.
I kind of do. Let's see what analyst estimates are, actually.
Yeah, I was taking a peek at that real quick.
EPS growth is very low, 691 to 844. Revenue growth, very low again. So it's not much growth there, but it's a stable company with, I think, a good brand name. Mo, why don't you do a 10-year analysis?
Okay.
I'm going to do a 20-year analysis,
Okay.
and we're going to talk through this. I'm going to talk through this. Now,
Okay.
guys, I do expect revenue to be, oh, look at that. Revenue is down 20%. And what was the market down last year? NASDAQ was basically down 20%.
20. Yeah, it was,
So
right.
I'm going to look at 20 years. And I'm going to assume revenue growth for the next 20 years. Mo, why don't you do a 5-year analysis? Why don't you do a 5-year analysis?
That would be a little smarter.
Okay, I'm going to do 20 year.
Okay.
Profit margin has been subdued. Okay, let's do 18, 24, 30. Higher free cash flow, 22, 26, 30. PE, 15, 16.5, 18, 15. So guys, as you're watching this, you have to sit there and get comfortable with how you look at these companies. The more you do the stock analyzer tool, the better. There's a reason why it was used 1.3 million times last year by our users. It's because it's such a popular tool that once you get the hang of it, you're going to become addicted to it. This tool alone is worth several dollars per day. Give me a break.
I've already used this probably 5 times today outside of the videos.
Yes, easily. Now, desired annual return, I'm going to go 11, 12 and a half, and 14. Now remember, the desired return is essentially your margin of safety.
Yeah.
The higher your desired return, the lower the stock price, better margin of safety. Mo, what were your assumptions?
So I went 1, 3, and 5 for the next 5 years.
Oh, I actually think it's aggressive.
Well, I think 5 is aggressive. I think 1 and 3 are reasonable. 5 is just.
If I were you, I'd put negative 3, 0,
Really?
and 3. Mo, if you expect stocks to be down for the next 10 years, that means the next 3 to 5 are going to be awful.
All right, let's do negative 2, 0, and 2. How about that?
Wuss. Profit margin, I think that profit margin is too high.
29.
Look at the last year's profit margin and free cash flow. I'm really trying to beat this up. I want you guys to all see I'm really trying to beat this up to show you the difference between short-term investing and long-term investing. Go ahead and do whatever you want to do.
Okay. 29, 32, 35.
Jesus Christ, I want to sell this guy my business.
All right. Next.
Go ahead.
24, 26, 28 free cash flow margin.
for it.
15, 16, 17 for PE.
Wonderful.
And same for price to free cash flow. And return 10, 12, and 14.
I'd be doing 18, 25, and 30. No, I'm kidding. Now, you guys heard what I did, and here are my values.
Let's see.
Look, I have red at the bottom, 65 to 80, 166 at the top, and it's basically green right now.
So even with the discounted cash flow margin that I put in, we're still not.
Holy cow.
Green. Yeah. So my low
No,
end.
you're still not all. I thought it was gonna be all red.
Oh, yeah.
I thought your highest price was gonna be like $60. I'm actually surprised by that, Mo.
Yeah.
Wow, good for you.
So there we go.
All right, so interesting. Now, I do think the question is, do you want to time things? If you
Right.
believe the market's going lower, there'll be better times to buy TROW, but it's your call completely, of course.
All right.
All right, next stock, Generac.
Yep.
Guys, Generac. This is
Big in the world of generators.
generators. Now, I want to make one note about Generac. 2 notes first. All-time high, $517 a share back in November of 2021, and it's currently at 110 with a 52-week low of 86.
That's erratic.
In 1 year, and 1 month, it went from $517 to $86. For anybody who tries to tell me that this is normal, shove it.
Yeah.
Here's the income statement. Look at this revenue. It's skyrocketed.
Oh, yeah.
Skyrocketed. Now it's stabilized, but let's go look at quarter to quarter because they just reported and they jumped up big. But look at their revenue. Look at this revenue drop.
Yep.
Sorry.
It's fallen.
887, 1.14.
Bit
Why
of
is there a
problem.
difference between their operating revenue and this revenue when all the other years were the same?
Oh, you're right.
Either way, I'm going to look at their revenue as 887 versus 1.14. That's a drop of 25%. I don't know. Whatever it
Could
is.
be argued that could continue to fall.
30%, not 30%. Yeah, and I would argue that's going to fall still as people put less and less money in their home. I have no idea. I have not listened to their calls. Let's see their free cash flow. Are you on the free cash flow?
Yeah.
How's their free cash flow looking?
Negative 42.5 million.
Oof.
This is quarterly.
Oof.
Yeah.
Okay, let's see their 8 pillars. A lot of X's here. So you're probably like, well, Paul, what do you like about Generac? Well, the reason I like Generac is I think they're the leader of generators. When I look at generators out there, I see 70, 80% of them are Generac. And I like the small name, probably not much hype, even though it's $517 a share.
Yeah, it's only a $6.3 billion business for its market cap.
At one point was a $37 billion
Right.
business. Well, I think we should do a stock analyzer on this one.
All right.
You do 5 years again.
Okay.
And I'll do 20. And look at this return on invested capital over 10 years, 13.2. It is decreasing, but that's likely to happen when your profit's decreasing as well.
Okay. Let's see here.
Okay, 8. I did revenue growth of 369, profit margin of 8, 9.5, and 11. And the reason being, they're pretty consistent in the 10 to 11 range. So I'm going to give them a little bit of buffer here because as things slow down a little bit, maybe their profit goes down. Remember, you don't want to value everything based on their best years. And we've had a boom market for residential in the last 10 years. Mm-hmm. The hard part is in this revenue growth, this assumes they stabilize. If they go down, this is useless.
Yeah.
All right. So
Actually,
free cash flow margin.
Should go lower here.
I'm going to do 7, 9, 7, 8.5, and 10 PE. I'm going to do a little bit lower on PE to factor in that drop in revenue. I'm going to do 13, 15, and 17 because they still have to drop their revenue a little bit. I think that revenue is still going to continue to drop. And that's something to factor in when you're looking at things. And I want to understand their free cash flow issue in the last year. Desired annual return. I'm going to go with 11.5, 13, and 14.5. Okay, Mo, why don't you tell me your assumptions? Go on Mo's screen.
So I did -2, 0, and 2 for revenue growth.
Okay.
Okay. Profit margin 5, 7, and 9.
Wowzer. Okay.
Free cash flow margin the same.
Okay.
PE 14, 15, and 16.
Yep.
Same for price to free cash flow. And for my return, I did 11, 13, and 15.
The only thing different I would have done, I liked all your numbers. I would have done 10, 12, 14 on desired return because you already beat it up with -2. However,
I did, but there's a lot of uncertainty out there.
you're right. So what'd you get your numbers at?
Yeah. So let's see. $38 to $75, middle ground 56.
Okay, now he did a 5-year return.
Yes, that's
I
5
did
years.
20 years. I have a low of 60 to 70, a high of 130 to 140, a middle price of 88 to 100. I have it in my watch list at 75. I got to change that actually because I don't like that price. I'm actually going to add it to my watch list at $90. And this doesn't mean I'm buying it at $90. What it means is I'll probably start selling puts at lower prices. And if you like that idea, all the more reason to join our community. You can learn how to make money while waiting for stocks to fall to the prices you want them to.
This is a surprisingly volatile stock,
Well,
isn't it?
I mean, to go from 517 to 86 in 13 and a half months.
Like every day I look at this thing, it's up 8%, down 3%.
Well, they just reported earnings.
Oh, very recently?
And they were up like 15% that day.
Okay.
And then so if you go look at the chart, look at their 1 month chart. It's insane.
Because this is
look at this, Mo.
Our friend Darnell sends us all the time.
This is sub 95, and then it hit like 115, like literally a week later. They reported earnings right here, and it skyrocketed.
Okay. All right.
All right, next company.
Next.
Tyson Foods, they just reported, and they got slammed.
Speaking of stocks that got beat down.
Okay, so Tyson Foods fell.
me-
Oh my gosh. Okay, it fell $10, 16.4% after hours. I mean, during the day. What happened, Mo?
So they reported earnings. Their estimate was 79 cents earnings per share. They came in at -4 cents.
Jesus
so that's
Christ.
not good.
Was it what happened to their cash
I
flow?
don't
Was
know.
it a one-time?
We have to look at that.
Okay.
I don't know. And then they reported 1.13 billion in revenue. Estimation was 1.6 or 13.6. So they missed
Wait a
that.
second. What was their revenue reported?
13.1.
Okay, you said 1.3.
Oh, my bad.
1.13. Okay, so 13.1.
13.1. 13.6 was the estimation. Missed that too.
$500 million.
Yeah, on top of the earnings per share thing. Let's see what actually happened with the earnings per share thing. Though.
Now, guys, usually when you see that big of a difference between,
something wrong.
Or there was like a one-time write-off charge. Like they sat there and said, listen, we made this investment, it was terrible, we're writing it off, and it caused us to lose 80 cents per share.
Yeah.
80 cents per, how many shares outstanding do they have? 80 cents per share is a big miss. They have 56 million, so 80 cents a share. All right, actually makes sense. Their gross margin is very low. I mean, look at this business, guys. 10% gross margin, 4.5% bottom line. This is a tough business. $21 billion market cap, $38 billion enterprise value. I'm already sensing a lot of debt here, and I don't like that. Let's see where their debt ratios are based on the 8 pillars. So look, right there, there's an X right here. They have 7 times their average free cash flow in the last 5 years debt level. That's a lot. Their average 5-year free cash flow is $1.6 billion. So they have 7 times that amount. Debt can be harmful very much on companies, especially with lower margins. The current enterprise value of the business, that means the market value and the debt essentially, is 38 billion and the market cap is 21, $16 billion in debt on a $21 billion market cap business. That's a lot.
It said operating income of $418 million, down 84% from the year prior.
Wow.
Earnings per share of 61. What the hell is going on here?
Look at their price to sales ratio, 0.4. Their 5-year return on invested capital is 8%. I mean, what do they look at their dividend yield. Look at their dividend yield. They can afford this dividend. Well, they're eating up a lot of their free cash flow last year, but it's less than half of their 5-year average. Let's look at their cash flow in the last 5 years. What's happened with that? Ooh.
Oh, man.
Interesting. Guys, look at these free cash flow numbers. 1.8, 1.25, 2.7, 2.6, 750, 786. Remember, if you don't have our software, you got to do this all by hand. So get our software, you get it all right here for you. Done the math done for you. But look at previously. Mo, ready for this one? Mm-hmm. I don't like it.
Yeah. Why go any deeper?
Now, before I talk too stupidly, I mean, the PE is 9.
Quarterly numbers.
The PE is 9. I mean, they have a pretty stable business, Mo. They have Jimmy Dean, Hillshire Farm, Ballpark, Sara Lee.
Great. I mean, they're the big player in that space. There's no doubt about that.
Wow. What's with all the debt? I think you got to understand the debt in this business because a company with a lot of debt, so their long-term debt is 7 times their 5-year free cash flow, which means their long-term debt is about $11.3 billion. Okay, if the rate goes up by 2.5%, that's a total of $80 million a year. That's a big chunk of their cash flow that's already getting depressed right now. I don't know. It could be okay, but it's a lot of debt. It's a lot of debt.
Yeah.
For such a low margin business. It's all about the volume here.
Right.
What if all of a sudden they have salmonella poisoning at some point? And that's going to really rip things to shreds. Listen, I shouldn't be negative about that because anything can happen to a lot of businesses. But businesses with higher margin can accommodate that much better.
Yeah.
Absorb it much better. This is low margin. This is 10% gross margin. What does that mean? It means that every dollar they sell extra, 10% goes to paying. They can now pay taxes and overhead with that number. The bottom line after taxes and overhead, the average 5 years is 5.6, and their trailing 12 months is 4.4. All right, last stock, Southwest Airlines. Now, I'm going to talk about this one high level.
Okay.
Mo, here's why I like Southwest Airlines. I think it's getting beaten up quite a bit, and here's why. This is their income statement over the last quarter. Let's go quarterly.
Okay.
Cost of goods sold has basically, in the past, before COVID, so we should look at cost of goods sold. Let's look at it annual. Actually, let's look at the 4 quarters.
Okay.
Guys, cost of goods sold is the direct cost to sell a product or service, okay? That's what creates the gross margin. Revenue minus your cost of goods sold is your gross margin, gross profit. And the margin is the gross profit divided by the operating revenue. Now, let's look at it here. 2017, 30%, something like that. Not 30%. Yeah, 30-some%. 2018, 30%. 2019, 30%. Skip 2020, 2021 because of all the garbage. 22, 25%. 23, 20%. And if you look at the quarter by quarter numbers, gross profit, look at this, 16% 2 quarters ago. Last quarter, what is that, 13%? 12%? It's garbage.
Yeah.
There's been a lot of issues with their services. You saw the breakdown, and I'm sure they're still coming off of the technical shutdowns. I think this is a company that's getting beaten up because of that. And I think they were a great operated business for the years before COVID. I don't think that's changed. There's just some issues that to work through. And I'm going to take advantage of that, in my opinion, to buy it at lower prices. Yeah. That's my thesis on Southwest. They've started to stabilize their debt. Look at their balance sheet. We'll go quarter to quarter on balance sheet. Look at their long-term liabilities. Oh, well, it's still higher than it was before, but they've paid it down from quarter to the trend is going lower, even though it jumps up a little bit. Look at, that's current liabilities. Disregard that. Total liabilities. Okay, it's pretty stable. It's down from its peak, but it's pretty stable. Look at their long-term liabilities, Momo. It's going down.
Yep, it's coming down for sure.
They're paying down their long-term liabilities, okay? Now they have a lot of deferred liabilities, the payables and things like that. Total current liabilities are increasing or the same. So I'm looking at it going, okay, they've got some kinks to work out. But Southwest has been well known as a great operator, was profitable like 48 years in a row before COVID happened. I'm still a believer in Southwest.
Are you worried about share dilution at all?
Well, that was an issue.
I mean, it was for a reason.
Yes, it was for a reason.
So it's not like it came out of nowhere.
And it's stabilized in the last year or so. If you look at this, $5.91 to $5.94 since March of 2021. So it's been very little, very, very little, and their average diluted shares outstanding has decreased. So again, Southwest is working through its problems, but if you can value Southwest based on historical numbers, well, look at their revenue, by the way. Historical revenue, look at their annual, look at the 4 quarters revenue. I believe, is that a record? That is a record.
Yeah, it's a record.
24.83. That's the highest they've ever been.
Next closest was
22.17, right before the year before COVID, the last full year before COVID. Listen, say what you want, but remember, the best deals happen in great companies when they have short-term problems. I think Southwest is an example of that. I could be wrong. I was wrong on Carnival Cruise Line. I got lucky making money on Carnival Cruise Line, but it wasn't anything other than luck. Literally, it covered calls, took the stocks away from me at 30 or 28, and then it fell, and I started buying again at like 14 or something like that. So who knows what happens here, but I'm a believer in Southwest, and I'm going to, I have some puts on Southwest at lower prices. So guys, thanks very much. Again, $1 every day, $7 a day for the software, everythingmoney.com. Check it out.